Hello, everybody. My guest today is John Oechsle. He's the president and CEO at customer relationship management and marketing automation software provider SwiftPage. He has a 30-year track record of building highly profitable and sustainable revenue growth for emerging companies and established global leaders. He's been recognized several times for his involvement in the tech industry. John, are you ready to take us to the top?
Oh, I'm ready, man. How you doing?
I am doing well. So last time you were on was about a year ago, and there's one thing I remember from that interview that just floored me. I go, this is a guy that basically bought $70 million worth of ARR with other people's money, kept 60% equity for common, and then sold off a little piece of it later that basically made up the cost of that. And you basically got it for free, essentially, right?
Awesome. Matt, you got it right, man. It's called using other people's money.
I totally get it. So I want to start off, I want to assume my audience knows nothing about you for a quick second and then dive more into detail. So what is SwiftPage if people aren't familiar?
Yeah, SwiftPage been around since 2001. Started as a little email marketing company. So think like a Constant Contact or a MailChimp, etc. I was an early investor in the company back in 03, 04. Started advising the company probably in 06. Helped them form a board in 09, and then in 2012, I have a funny story. We had a board meeting. I went to the restroom. I came back, and they said, "Hey, man, you're the CEO." I said, come on, there's got to be a bathroom rule or something in here. So I took over as CEO in 2012. And, the story, we did a couple of real quick acquisitions and, took this little startup of 15 people to 350 Swifties around the world, 4 locations. And, we've been growing and having a lot of fun ever since.
Swifties, I love that. Hey, real quick, just so people can appreciate what you and your team have done since 2012 when you come in, what was kind of general, and you can give me a range here if you want, if you're comfortable with it, ARR then versus ARR now?
Yeah, so I won't give you numbers, but I would say over the last years, well, I would tell you when we acquired the companies in 2012,
that was the 70 million ARR, right?
Yeah, they were losing money,
yeah.
Right? So it was going this way, right? So we quickly turned that around.
John, sorry, was that your? Sorry, I don't mean to cut you off, but was that your only ARR at that point, or was the core business? I thought you told me the core business was doing 30. You bought 70.
Yeah. So what we were doing, the core business was the little email marketing company. So that was doing some recurring revenue at that point. Then we added on top of that. The revenue that we added was actually declining. It was a distressed asset. Well, we turned those around. So think of this as top line growers, and the MRR ARR is growing around 20% year over year. So we're trying to keep that growth going on the top line. Bottom line is on fire.
Profitable.
Very profitable. I mean, when we first acquired the companies back in 2013. We put a heavy investment into the business. So we went unprofitable for a year or two and then turned that around. And then, now we're profitable, growing the bottom line like crazy.
John, you have to remind us that when you did the $70 million, you bought $70 million in ARR with other people's money. Did you raise $70 million essentially to buy? Was it a 1-to-1 ratio there, or did you use public funds or the private equity fund behind you, or how did you fund that?
Yeah, so we were funded in a couple different ways. So Oechsle KKR was one of the players that came in and helped us from an institutional perspective. So did Jump Capital, and then from a debt perspective, we had Silicon Valley Bank that came in and helped us out. And it was not a 1-to-1 ratio. Well, it was a much better deal than that.
I was going to say,
you have to wait for the book to come out. It'll be a phenomenal book.
For the what to come out? Oh, the book. Yeah. I was going to say anything going through John, I would say John is going to get a $70 million ARR company. He's going to figure out how to talk and get it to like 30 or 40, right? That's how you do a good deal. All right. So John, where's most of the growth come? Okay. So acquisition stuff aside, you pulled a nice kind of playbook there. You're now profitable, growing 20% year over year, cash flow positive. Where's your head at? I mean, one of the things I always wonder about folks like you could do anything you want. You're working now inside a private equity firm. At some point, you stop learning, right? And then usually people end up leaving and starting something new. Where are you at right now?
Yeah, so I'll tell you what we're doing. We took a half a step back, and I think we might have talked about this last time. And we really have looked at the SMB industry, and we said, hey, you know what? We believe that the SMBs, there are 4 digital pillars that they need in order to grow. We call them presence, traffic, conversion, retention, and optimization tools. Presence, everybody knows what that is, websites, et cetera. Traffic drives traffic to the presence. That creates lead. Conversion and retention is all about converting leads to customers, retaining them, and growing them. Optimization tools are things like financial software, payment software, HR software, etc. So we are going to basically own conversion and retention for the SMB. We were dabbling in it when we were a little small email marketing company. Then we acquired, CRM. We're, big. Here's big news. So this is exclusive just for you. Nobody else knows about this. But man, we are going heavy into the marketing automation. We're launching ACT, the next generation, on November the 7th.
Great.
We're excited about that.
Is this via, by the way, built in-house or via acquisition?
Via acquisition.
Which company did you buy?
I can't tell you that.
Oh, come on. All right.
Can't tell you that, man. You get me in all kinds of trouble.
All right.
So we're going heavy into marketing automation. So again, what really looks at, and we're saying, conversion and retention. Forget about CRM, right? That is an old phrase. People have been talking about that. Customer relationship management. They've been talking about that since the 90s. CRM is not where it's at. It's conversion and retention. If you look about where all the big boys are going right now, what are they all doing? They're all going after 3 legs of a stool that makes up what I call conversion and retention, and that's CRM, marketing automation, and service management. Right, those 3 legs. If you have those 3 pieces, now there's lots of sub pieces underneath of that. But if you have those 3 pieces, you own conversion and retention for whatever space you're in. So if you're Salesforce, you're going to own it for the enterprise, right? If you're, you take a look at what Adobe just did, bought Marketo, and so you see all these players now are saying we have to have all 3 legs of the stool.
Do you feel like you have those other 2, and you're going to get the 3rd here with the marketing automation?
I think we've got 2 with the marketing automation. I think service management is an area that we've got to really go after. So I don't think we can sit here and say, some people have customized the ACT platform to be a service management platform, but out of the box, it's not right there. So I think that's really the next piece that we need to go after.
Yeah. And help us understand, just so people can kind of bucket you appropriately. I mean, should we think of you kind of like a constant contact in terms of like ARPU and customer count and things like that? Or are you kind of more mid-market enterprise?
No, we are definitely down in the small business area. So when I say SMB, we kind of break it down into 4 buckets, right? So the first bucket is what we call lower, middle, upper, small, right? So those are kind of more the larger companies in the SMB area, maybe 100 to 150 employees, et cetera. And then you get down to the next level is what we call small, which is kind of in that 50, person company range. And then because we're so creative with our names, the next one is small, which is kind of like that 15 to 25 person. And then down at the bottom, we call it the IBO, or individual business owner. And so, our sweet spot is really in that small to IBO area. You kind of go up a little bit into that lower, middle, upper, small sometimes.
Got it. When I talk to the folks at EIG and Endurance International, and they own a lot of brands, whether it's HostGator or Bluehost, and they're trying to buy up other kind of things in the space. They talk a ton about, you have a huge volume of these. You call them, I think, IBOs, the small or smaller or smallest thing. But if you have millions of these folks and you add $1 of ARPU or $3 of ARPU, it's a meaningful mover. Is that kind of along the lines of what you're thinking with adding another marketing kind of tool on? Is it an upsell?
Yeah, absolutely. So think about it a couple different ways. So in our portfolio of products, we have 2 distinct platforms. We call it the premium platform, and then we call it the ACT 365 platform. So I'll talk about the premium platform. Right now, we've got 84,000 customers, over 300,000 users on the premium platform right now. So that means every single morning, Nathan, over 300,000 people get up and they say, man, I'm using ACT to grow my business, which is fantastic, right? So now if you take a look at that and you say, okay, now if you add $200 to $300 a month for marketing automation on top of that, you do the math, right? Holy smokes, that just the growth goes off the charts. So the premium platform, and that's really geared towards that small, and then touching on that lower, middle, upper, small area is really the sweet spot on that. But like you said, there are millions of these IBOs and smalls that are out there. So then we created this platform called ACT 365. And what is that? It's basically It's a very light kind of CRM / marketing automation. It has great customer management. It's got fantastic opportunity and pipeline management. It's got email marketing built into it, and it's also integrated with Office 365. All of that for $10 a month, right? People spend more than that in Starbucks, for gosh sakes. You know, invest $10 a month to grow your business. And so that's really geared to go after and scoop up those millions and millions of these IBOs, not only in the US, but, you know, we're also using it as a geographic expansion tool to get into other countries. So it's really easy and cheap to pop it in. It runs in AWS, so you can pop it in any AWS instance around the world.
Mm-hmm. Now, leveraging and kind of going down each of these spokes you talked about in the stool, those 3 different ones, have you been able to keep this 20% kind of year-over-year growth pretty consistent since, call it 2013, 2012 when you took over?
Yeah, so a couple of different areas. So we've gone through 3 distinct eras. We might have talked about this last time. When we acquired the companies, they were distressed assets. We had a lot of work to do. So we went into what we call the transformation era, right? So we had to transform the technology because, when we acquired ACT, it was a closed desktop system. We have to transform the whole back office, the business units, the sales, the channel, et cetera, and heavy investment. So think of like the first 2 years were really the transformation era. And so, no, we did not have, 20% growth on that. We were really trying to have 2 businesses going, transforming the business and then trying to sell licenses and maintenance to keep the business afloat as we were going forward. But then once we got through that, we entered into what we call the conversion era. And back then, this is around May of 2015. Back then, we had about 60,000 customers. And we were like, how do we convert 60,000 customers from using, desktop licensed software and maybe spending some money on maintenance to an open cloud-enabled platform and subscription? And that's really when we started taking off, and we saw significant growth. We got 15, 20% growth, and then we've been able to sustain that since
since 20. So from 2015 to 2016 and onward, you've been able to kind of do 20 to 30% consistently.
Yeah, I think of 15, 16, and 17 as conversion era. Really good growth rates. Now we're entering into what we're calling the growth era. Right. And so what's the growth era? 3 legs of the stool on growth era, right? Number one is there's an enormous amount of opportunity for continued organic growth. We got a lot of ARPU movers that we can do as we go through. The second stool is really around geographic expansion. We're global. We're around the world, but really 6 countries really matter for us. US is obviously number 1, UK number 2, Canada is number 3, Australia is number 4, and then French and German. And so those are our big countries. But if you listen to those countries, we have a little bit of business down in Latin America. So there's huge opportunities in Brazil and Mexico for us. And then there's what we call non-ACT penetrated European countries that we're going after as well. So that's the second leg of the stool in growth. And then the third is acquisitions, right? Continue to grow through acquisitions. And so we're looking for not only 20% growth, but hopefully we can, in the growth era, get into that 25, 30% growth as we go forward.
Has your kind of, small and smaller kind of ACVs, have they increased since 2015 or no? Most of your growth has come from adding additional customers. I think you said 60,000 in 2015 and now you mentioned you're at 84,000.
Yeah. So I think, we've done a couple of things. One is we've had people that used to use ACT like 20 years ago that all of a sudden have said, oh my God, ACT is back, et cetera. So they've come back, and we call those legacy users. So we've seen, so an upgrade there. But we've also seen a lot of net new, right? So we've been penetrating into different segments of the market. It's funny. Anybody over 40 knows ACT, knows of somebody that uses ACT, has used ACT. Anybody under 40 can't spell ACT, right? Yeah. So we have, so there's positives and negatives associated with that. And so the positives is that it's a very well recognized brand. The negatives is that, man, it's been around a long time. Is it old software, et cetera? Now you get to the segment of people that never even heard of ACT before. You don't have any of that baggage. You can go right after them and say, hey, this is what you need to grow your business.
John, just to be clear though, what I'm curious at is like when you had 60,000 folks, whatever they were paying per year, is it still about kind of the same today, or have you driven meaningful kind of ARPU expansion?
Oh, meaningful ARPU expansion. So think about those 60,000 customers back then. They were buying a license, and only 42% of them were paying maintenance. All right, and And so now you switch that around, and you've got, a series of people that are paying us subscription rates at a much higher ARPU. So, the ARPU is continuing to increase, and we've got some more room to go in the ARPU as well.
Yeah, that's good. I mean, you publicly revealed via Inc. in 2015 that you did about, I think, $26.2 million in revenue. That's what you put out on Inc., right?
Could be, yeah.
I
would say that.
Oh no, I'm sorry. I'll just quote it. I'm looking at it right now on my screen, right? So 26.2 million in 2015. John here listed as CEO, and if there were 60,000 customers, then that's about a $437 kind of ACV. So obviously, if we multiply that 437 today, now you're well north of that. You said you've increased your ACV, but if you multiply that as a minimum times your 84,000 customers today, that puts you north of $36 million in ARR. Is that generally fair math?
Yeah, your math is right. Your math is good. Yeah,
when do you break? Do you have 100 in your sites yet, or no?
Oh my God, Nathan, we've got 100 right in our sites.
Like how close? Like this year, next year?
I'd say give me about 2.5 years.
Interesting. Okay. And what
you'll be the first to know. But when we're getting ready,
good.
We'll get on this call and I'll let you know.
Good. Well, I just released a huge analysis of kind of Slack's S1 and Qualtrics as well. I had Ryan on and I said, look, Ryan, you check all the check boxes in terms of like, this is the perfect profile of a company to go public. What's happening. And then sure enough, a couple of weeks later, he's fine to go public. So, I'll wait to obviously hear that from you. You guys are in a hot space. I mean, what I would ask is, Constant Contact was not loved by the public markets at all when you looked at their PE ratio relative to Salesforce. And it's like, why? And well, their churn was through the roof, right? So what's your churn today and how are you managing that?
Yeah, we keep our churn down below 1.5%. We're probably one of the best in the
monthly
industry.
or annually?
Monthly.
Logo or revenue?
That's logo. Right?
1.5% logo churn per month.
And actually, revenue is probably lower because what we do is from a churn perspective, we look at 3 levels of churn. We look at unit churn, logo churn, and then we look at revenue churn. So, and they're all basically hovering in that 1.5%. Some are a little bit lower. But yeah, I mean, once we get you past that first year. And so anytime you're dealing with CRMs and small businesses or whatever, you win or lose your customers in the first 45 to 60 days, right? When they're coming on. If you can get them past that and you get them through that first year, I got you for 6.2 years, right? That's our average lifespan of a customer.
6.2 years. Wow. Okay.
Yeah. So, and that's where I think the difference is, Nathan, and this is so important. I think you see a lot of marketing automation players that are out there that are, going like crazy and, they're growing or whatever, but their churn is so high. And the reason being is that it's super easy to switch out of marketing automation software, right? It's like, let me take my stuff out of there and put it in something else. If you design and start running your business on a solid CRM, it's a little bit more difficult to rip that out and put something else in. So we've got that stickiness of CRM, and now we're adding marketing automation on top of that. And I think it's a real winning formula.
Yeah. Now, I'm going to do a calculation here to try and understand your dollar-based lifetime value and then see how you actually use that to drive decision-making. At 1.5% logo churn per month, if I divide that, 1 divided by 0.015, that's 67 months essentially of lifetime value, or about 5.5 years. If I multiply that times the ARPU you had back 5 years ago or 4 years ago, it's higher than that now. That puts your LTV in dollars almost at $30,000 per customer. Is that accurate? I mean, is that accurate in terms of what you're using to forecast today?
Yeah, it's probably a little bit high. Your math's a little bit high, but it's not. It's within the ballpark. Yeah.
And how do you use? A lot of people, I think, use LTV, the dollar figure, in ways that are not healthy. You hear the 3-to-1 CAC ratio, blah, blah, but a lot of times there's just things that math can't take care of. So how do you use that LTV and dollar figure as a kind of indicator strategically for you?
Yeah, the LTV is here's one. We absolutely we look at LTV. I think the most important thing that we look at is CAC, right? What is our CAC and what is our payback, right? That's the real payback in months. So those are the real things that drive us. And I'll tell you, sometimes we make decisions to say, you know what, it's okay if our CAC goes through the roof because we're going to get more people on board.
Yep.
And then kind of nurture it, particularly if we have such a long lifetime value. Right. So I think we look at those two metrics more than we look at, long lifetime value.
What is your payback period today in terms of months?
Yeah, it's about six to 7 months right now.
Okay. That's pretty good. I mean, that's pretty good. And so what does that bring CAC to then?
So the CAC, so I got to be careful about what I can.
You can give me a range. Yeah.
So yeah, our CAC, so think about our CAC. Oh man, it's below, from a logo perspective, it's below $500.
Okay, below $500, and you mean to acquire a logo?
Yeah.
Yeah. Okay. I mean, that's pretty healthy, right? So, I mean, if you're saying it's going to take you 6 months to recover that, though, that means you're only factoring an ARPU of like $90.
Yeah.
Is that right?
Yeah. So what we do, yes, absolutely.
Okay.
So if you look at that, so anywhere of an ARPU of anywhere from 90 to $150 per logo.
Yep. And these are kind of new onboarding that you're onboarding. Okay. Yeah. Well, but that ARPU is way less than what you had 4 or 5 years ago. You told me you've increased it. Oh, that's monthly. Yeah. Got it. Yeah. Okay, good. That makes sense. 6-month payback. And are you getting, by the way, I'm curious, from the private equity firm, are you getting any pressure to drive that payback period longer? They're saying, look, we have cash, pay $2 to win the customer.
No. Actually, so one of the things that has happened since our last conversation, I think back in our last conversation about a year ago, we were still owned by the institutional investors that I was talking about, and 62% was owned by the common, et cetera. So in May of this year, we actually recapped the company and brought in a whole new set of investors, and we're able to take out the entire existing investor base and the founders, and everybody got a really, really nice return. Everybody was very, very happy. But we brought in SFW Capital based out of New York. And these guys, the majority owners of the company right now, fantastic partners to have. They understand SMB really, really well.
Still private equity, though.
Still private equity, and they are really, really committed to funding our growth era. And so, we're, and they're putting their money where their mouth is. They not only did the recap, but we're turning right around and doing a quick acquisition right after that. So. I'm really looking forward to working with these guys to take us to 100 million.
Good. How many folks are on the team today?
From the SwiftPage team?
Yeah.
We're probably about 200 Swifties strong. And we've got another 50 or so over in Chennai that are not employees, but they're all part of SwiftPage Nation. So think about 200, 250.
Okay. And Denver and then remote?
So Denver's our headquarters, and then we have a large operations center down in Arizona and a large operations center over in Newcastle, UK.
Very good. All right, John, let's wrap up here with the famous 5. Number 1, what's your favorite business book?
Oh, man. The number 1 book that I always like is Outliers by Malcolm Gladwell. Best book I've ever written.
Number 2,
read, right? Read, yeah. I didn't write it.
We wish, right? Yeah. All right, number 2, is there a CEO, an under-the-radar CEO you're following or studying?
The guy that I constantly always follow is my mentor, has been my mentor since ever, is a guy named Jerry Stead. I worked for him at IHS. We did phenomenal things together. He's in his 70s and still going strong. And he's somebody that I constantly follow and talk to almost on a monthly basis.
Oh, good. Number 3, what's your favorite online tool for building your business besides your own?
Besides my own, I don't know. I think, from our standpoint, we use, I will tell you that Zora is a fantastic billing management system, subscription management system. And I think that one, as we really have learned what it's been capable of doing, has really changed our business.
I'm surprised you say that, because Tina and them, they're really focused on enterprise, like Fortune 1000 kind of brands. But you like them too.
Oh, I love them. Yeah, these guys. And we've been with them now for about 4 years, and they've been fantastic to work with.
Number 4, how many hours of sleep are you getting every night?
Oh, I try and get at least 6 hours of sleep. So I'm a early to bed and early to rise guy.
That's good. Number 5. Tell me situation here. Married, single, kiddos?
Married, a wonderful woman. I got 4 kids, 3 grandkids.
Oh, wow.
My family is my rock, is my lifeblood. I got to be around them.
And how old are you, John?
Oh, I am now 56 years old. I'm an old man.
56 years young. All right. Last question. What do you wish your 20-year-old self knew?
I think my 20-year-old self, I wish I would have realized how fun it is to just dive in and run companies and take chances and make things happen.
Guys, it's fun to dive in and take chances. Coming from John again, now running SwiftPage. The company was founded in 2001. Just did a big recap. They went from 60,000 customers in 2015 and 26.2 million bucks in revenue up to 84,000 customers today. They're scaling out ARPUs between 90 bucks and 150 bucks per month to get that customer. They're spending less than 500 bucks, so 6-month payback period as they look to scale. They've got a big announcement coming up soon where they're going to be moving into the marketing automation space as their team of 250 people continue to work really, really hard in Denver and other remote locations. John, thanks for taking us to the top.
Thanks, Nathan. It's been fun. Thanks, man.